When the stock market crashes and trillions of dollars in value disappear, where does that money actually go? Did someone take it? Is it sitting in a bank account somewhere? Or did it move overseas? The answer is none of those things happened because most of that money never existed in the first place. When you see headlines like $2 trillion wiped out in a market crash, that's not describing money moving from one place to another. It's describing prices being reset. The market collectively saying these companies aren't worth what we thought. And by the end of this video, you'll understand exactly where wealth goes during a crash and why most people lose money while a small group profit massively. When the stock market crashes, market value doesn't disappear because most of it never existed as cash in the first place. Say you buy 10 shares of a stock at $100 per share. You've spent $1,000. That money left your bank account and went to whoever sold you those shares. Now the stock is trading at $100 per share. So your account shows $1,000 in value. But that $1,000 isn't cash sitting somewhere. It's just the current price multiplied by the number of shares you own. Now let's say the stock drops to $50 per share. Your account now shows $500. You've lost $500. So where did that $500 go? Nowhere, because that extra $500 was never sitting in an account waiting to be taken. It was just valuation, and it evaporated when the price changed. The only real money that ever changed hands was the $1,000 you paid when you bought the shares. That went to the seller, it's in their bank account, it never came back. What you actually own when you purchase a stock is shares. And shares are only worth what someone else is willing to pay for them right now. So when the price drops from $100 to $50, the market is simply saying, we're no longer willing to pay $100 for this, we'll only pay $50. That's a repricing, it's not a transfer. On a bigger scale, to really illustrate this point, imagine a company has 1 billion shares. The stock is trading at $100. So the market cap is $100 billion. Then the stock falls to $80. Now the market cap is $80 billion. Headlines will say, oh, $20 billion of wealth was wiped out. But here's the thing. No one actually traded or bought all 1 billion shares at $100. Maybe only a few thousand shares traded at that price. But because those few shares traded at $100, we valued the entire company at that level. And when the price falls to $80, the entire company gets repriced, even though the vast majority of shares never traded. That $20 billion, it didn't go anywhere. It just stopped existing as market value. This is the difference between paper losses and realized losses. If you bought at $100 and the stock falls to $50, you have a paper loss of $50 per share. But it's on paper, it's not real until you sell. If you hold and the stock goes back to $100, that paper loss disappears, you're back to even. But if you panic and sell at $50, you've turned that paper loss into a realized loss. You paid $100, you got back $50, and you lost $50 in actual cash. That $50 wasn't sitting somewhere waiting to be recovered. It represents the difference between what you paid and what the market was willing to pay when you sold. The person who sold you the shares at $100 already got your money. They kept it. This is why people say holding through the crash matters. If you don't sell, the loss stays on paper, but if you do sell, it becomes permanent. And this is also why crashes create massive wealth redistribution. Now, even though most of the lost market cap never existed as cash, there is real money moving during a crash. When markets panic, some investors sell their stocks. That gives them cash, and they usually move that cash into safer assets. This is called a flight to safety. During the 2008 financial crisis, there was a massive shift out of stocks and into US Treasury bonds. In 2023, during periods of high volatility, institutional investors moved tens of billions of dollars into money market funds. So when money leaves stocks, where does that real cash go? First is US Treasury bonds. Government bonds are considered the safest assets in the world, so when stocks crash, demand for treasuries rise, and prices of bonds go up and yields go down. And during almost every major crisis since World War II, the US Treasuries have been the primary safe haven. Second is gold. During the sharpest phase of the 2008 financial crisis, gold rose by more than 20%. And gold is a physical asset and it isn't tied to any single company or government. So when trust in financial markets breaks down, investors often move into gold. But gold isn't a perfect safe haven. During COVID and even recently, it didn't always behave the way people expected. And third is currencies like the Japanese yen, which historically strengthen during market stress as global investors unwind risk. And finally, people will just hold plain cash. Sometimes people sell everything and just hold cash. Yes, it earns almost nothing, but it doesn't fall in a crash. And psychologically, holding cash feels safer when everything else is dropping. So yes, some real money does move during crashes, usually from stocks into bonds, gold, cash, and other defensive assets. But most of the lost trillions weren't transferred anywhere. They were erased when asset prices reset. Now, when you hear market crash, you think people lose money. But some people make massive amounts of money during crashes, especially if you're an early seller. If you recognize the risk and you sell before the crash, you lock in higher prices. You saw a lot of investors exit tech stocks before the dot-com bubble burst, and they got out near the top while everyone else held through the collapse. Short sellers also make a lot of money on market crashes. Super simple, short selling is when you bet that a stock will go down. How it works is you borrow shares from someone else and you immediately sell them at the current price, let's say $100. Then the stock drops to $50, you buy the shares back at $50 and you return them to the person you borrowed them from. So imagine you sold it at $100, you bought it back at $50, you made $50 per share. Short sellers are one of the few groups that profit directly when markets fall. Some hedge funds, they made billions of dollars during '08 by shorting mortgage-backed securities and financial stocks. Market crashes also bring out a lot of players into the market who have been reluctant to participate when things were so overvalued. If you have cash during a crash and you can buy when everyone else is panicking, you can acquire assets at massive discounts. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." People who bought stocks in March 2009, right after the financial crisis bottomed, they saw massive returns over the next decade. And people who bought in March 2020 after the COVID crash, they made a lot of money as markets recovered in the following months. But most people don't do this. They panic, they sell near the bottom, and they miss the recovery. So crashes can trigger a massive redistribution of wealth from people who sell late to those who sold early, bet against the market, or had the cash and discipline to buy when everyone else was afraid. But the biggest reason why crashes tend to spiral so violently all comes down to leverage. When investors buy stocks with borrowed money called margin, even a small drop in price can force them to sell. Imagine you have $10,000 and you borrow another $10,000 from your broker. Now you have $20K to invest and you buy $20K worth of stock. The stock drops 20% and your position is now $16,000. But you still owe $10,000 to your broker. So your actual equity in the trade is only $6,000. So you started with $10,000, now you have $6,000. You've lost 40% of your money even though the stock only dropped 20%. And if the stock keeps falling, your broker issues a margin call. They demand that you either add more cash or you sell your stocks to pay back the loan. Most people, they don't have extra cash, so they're forced to sell, which pushes prices down even further, which triggers more margin calls, which forces more selling. This feedback loop is what turns normal market declines into crashes, and that's exactly what happened in 1929. Investors were buying stocks with massive amounts of borrowed money. So when prices started falling, margin calls forced selling, and that selling drove prices even lower, which triggered more margin calls. The market peaked in September 1929, and it didn't fully recover for decades. And even though the lost market cap is just asset prices being reset, it has real economic consequences. This is something called the wealth effect. When people's portfolios lose balance, they feel poorer, even if they don't sell. And when people feel poorer, they spend less. They delay buying a car, they cancel vacations, they cut back on restaurants. That drop in spending slows the economy, which hurts businesses, which leads to layoffs, which can even start recessions. The Federal Reserve estimates that for every dollar of stock market wealth lost, consumer spending falls by a few cents. That doesn't sound like much, but when trillions of dollars in wealth disappear, those few cents turn into a massive drag on the entire economy. So even though most of the money never existed as cash, the loss of perceived wealth has very real consequences. So where does money go when the market crashes? The truth is that most of it never existed. Market value gets repriced, not transferred, and some real cash moves into safer assets, and wealth does get redistributed, but the lost trillions were mostly just erased expectations. But here's the bigger lesson. If market crashes teach us anything, it's that for long-term investors, they actually aren't disasters. There's a lot of opportunities in them. Market crashes are some of the greatest opportunities to build long-term wealth because you're able to buy individual stocks or even just the S&P 500 at much cheaper prices. And if you believe in the market long-term or you believe in a company long-term, you're lowering your cost basis and you're setting yourself up for stronger returns when prices eventually recover. Understanding this doesn't mean that you can predict the next crash. It just means you understand how the system works. And maybe next time the market drops 20%, instead of asking, where did my money go? You'll realize something more important. Market crashes are part of the game. And if you're thinking long term, they can actually offer a lot of opportunity.